I hope you learned something new today. My name is Ravi, and I enjoy studying businesses, understanding value chains, and I believe that great amount of wealth can be created from equities, especially from the stock market, given the situation that we are in, because we are in India and seeing the kind of growth in the GDP numbers that we see. We are in a country which reports the highest GDP growth number as per IMF data, and businesses typically grow almost 2x the GDP, and there are companies much faster, showing better 20 odd percentages of revenues, for example, and through efficiencies, these companies could also create even better growth in their earnings. We are very privileged to be born in India, and the demographics that we have guarantees better returns and more people joining the workforce in the next 15, 20 odd years. So, with that context, let's get started. Today, I wanted to cover how we navigate the market cycles. We are currently seen almost a 10% correction on Nifty. The broader markets must have corrected even more. Nifty, as we speak, has touched 200 DMA, which is normally seen as a good sign to bulk invest. Whenever Nifty has touched the 200-day moving average, it has retraced back and given phenomenal returns to investors. So let's go on our 200-day moving average. As you would see, we are just 200-day moving average. There was a sharp bounce in the first half of the trading day, but as you can see, Ukraine decided to launch a missile today, and that ended up taking away most of the gains from the day. So 300 odd points which we had gained today, it came down by 250 points, so almost like a 30 odd 50 odd points gain. But again, that is a very small view. Let's dive into a deeper view. I would like to start with a quote from Howard Marks. Howard Marks wrote this book called Mastering the Market Cycles, and I really believe that by playing to the cycles, we can create huge amount of wealth. This quote resonates well with me because it's something you learn when you stay invested in the market for long. As it says, there's no asset bad if bought at too high a price, and the few assets so bad that they can't be a good investment if bought cheap enough. I think what he points towards is the valuation, and valuation is of utmost importance to me, who's a value investor, or at least I would like to believe that. The key point here is that anything bought at the right price can become a good investment, and if a great company is bought at the wrong valuations, you might end up in trouble. Now I would like you to have a quick look at this graph. This is something that I think most investors miss out, and also they don't keep this business cycle in mind while investing. So it's always important to look at where we are in the market cycle. Most cycles play out in this typical format. The bull run starts with optimism, goes into enthusiasm, and there's exuberance and euphoria. Most investors are happy with the returns they see on a day-to-day and month-to-month basis. It is during this time of exuberance and euphoria when most people would enter the market or invest more money, which actually goes against the theory of cycles, because this is when you should be more cautious. Most investors are greedy at this time and making huge mistakes that the market hardly forgives. when an investor gets punished heavily, losing half of their wealth, they quit the market and they think equity investing is not for them. What they don't understand is how they approach the market. That is where they should be focusing more and more than what particular stock they are buying. Euphoria changes into anxiety as the market starts dropping, which is what we're seeing right now. We are still in a structural bull run as far as India is concerned. There could be a black swan event, but we are in an anxiety or denial phase where we have seen a 10% odd correction, which is very new to most of the investors who have started investing after COVID. We haven't seen this kind of a prolonged correction. Every opportunity before this was something to buy into, but now sentiments have changed. A lot of people were thinking, why isn't the market correcting and why don't we get a dip where we can enter? And now, when the markets have finally corrected a bit, people are again fearful of investing. That is the basic psychology that we have to overcome as investors. When a bull market ends, we see a lot of fear and panic in investors, and that is when people start withdrawing money, and people feel that this is all going to end. But that is the time to remain invested. If your pocket allows, you should start investing more, because it is at the time of panic and discouragement when markets favor you. As investors, we have to believe in the law of averages, and everything averages out. So this return that we see on Nifty and on small cap indexes, which is far ahead of our averages, are going to be brought down back to the average. And how will that happen? That will only happen when the markets correct. We go back into a bear run and markets fall by 30-40%, and we'll get back to our average return of 12 to 15% on Nifty and 15 to 20% on small cap index. All of these years of returns are going to be averaged out. As investors, I think the key point here is to not get influenced by the market's enthusiasm, but rather have realistic expectations. When the markets are down, invest more money than fear. With that similar theme, I also wanted to touch quickly on how some total or thematic funds are coming out these days, especially focusing on themes like defense, railways, and PSUs. A lot of investors who invest in these funds end up making this mistake of investing in these funds at the wrong time. The reason for that is most of these hot themes are not favorable at this time. Most of these cycles have already played out for these themes, be it defense, PSU, be it rail, already. And the only reason these themes are brought in is because it is easier for these fund houses to get people to invest in these themes. They can show a track record of say 100% of return in last 2 years, and which is very lucrative. And most people think past returns are an indication of future return, which is clearly not the case. So it also helps them get more AUM, because people are more inclined to invest in hot themes. These are funds which are pushed aggressively. A lot of commission is charged by brokers on these funds. As the retail investor, we should stay away from thematic funds and stick to more multi-asset and flexi cap funds. If you understand sectors, definitely play these thematic funds, but don't go into hot themes. Rather stick to themes which you feel are going to turn around in the times to come. Just to give an example, right now we see themes which are beaten down to death, be it chemicals or pharma for that matter, even FMCG industries, banks. So those are the things where you have to of a thematic fund, but not things which are running hot. Another view of similar picture. So you see, what you see here is AUM AMFI data for AUMs of most funds, and most of the money or the AUM that has come into sectoral and thematic funds, and that is concerning to me, honestly. I think a lot of these people who have expectations of getting same kind of returns that they've gotten on these funds are going to have an expectation check. And as you go down this graph, you would see a lot less money is going to other smaller mid cap and large funds. So that's slightly concerning, but it is what it is. Today, I want to touch on this one sector or theme which I see having a lot of tailwinds even in the times to come. I would like to highlight that as a disclosure, this is something that I am very bullish about because I own a couple of stocks in this particular sector. I hold it from a lower level, so a lot of these stocks have run up already quite a bit, but I still see a lot of steam left in this industry, and specifically some of these companies under in this sector are showing improvements in margin and exponential growth revenues. So just to give you a quick view of the overall sector and how is it looking now. This is an extract from an article written a few months ago, and this talks about the transformer crisis. So, as it stands currently, there is a lot of capex being done in transformers and in transmission overall. The government has announced transmission capex of 9.2 lakh crores. Of that, 2.3 lakh crores are going into transformers. You can just get a sense of how big this transformer capex is. I was listening to this podcast earlier, and it was very interesting to see that in the grid investments in the UK and the US, almost no capex has been done in the last 45-50 years in the grid. And even with Trump coming into power, the expectation is that renewable energy will not be much of a focus. Microsoft has announced a lot of nuclear power plants are being set up by the likes of Microsoft, Oracle, and Google for their data centers. So just for power transfer, 50 to 70 million is being spent to set up these power transformers because you need them for transmission of electricity. And so that is the kind of tailwind the overall industry is facing top down. Now, of course, this is in no way a structural industry. It is definitely a cyclical industry. The cycles last time around early 2000 lasted for 5 years. The margins expanded to almost 2022 which is for most of the incumbents in the industry. And the expectation is that again the cycle started from 22, so it might last till say 27 and 28, because after that a lot of picks is being done which will be live by then, and chances are the market will go from scarcity in supply to oversupply. A lot of these companies will have to take price cuts. Just to come back on this article, there has been a constant upward trajectory in terms of the lead time that these suppliers are seeing. So most of the suppliers either have already have order backlogs which is constantly increasing on average. So that's what this article highlights. Also, I was recently going through the con call of one of the players from the transformer industry, and I saw that it's not just India where the power capex is happening, but it is all over the globe. So that opens a lot of doors for most of these Indian players who are just getting their hands dirty and to increase their share of export. And it was very interesting to see that at this point there is so much demand for these and so much capex being done in transmission that it is not the price, it is the technology that this player claims to have, and even goes ahead to say that technology is not even an issue, it is the delivery which is an issue. A lot of these overseas players are occupied for the next 2.5 to 3 years, so delivery plays a major role. That shows the kind of tailwinds and the kind of demand that is there from the end user. People are ready to pay higher prices even if they get an earlier delivery. The kind of capacity becomes an important consideration here, and we'll come in a while to see what are the typical capacities that most of the players here have in India. Now, going ahead, these are some of the key players that we have listed in the Indian stock market. Transformers and Rectifiers India is one, CG Power Solutions is one, Bharat Bijlee is another player, Voltamp, Indotech, Shilchar, Danish, JP. A lot of these players are listed in the market. Voltamp has 14,000 MVA capacity, Trill has 40,000 MVA capacity, Shilchar 7,500, Danish 51, Bharat Bijlee 18,000, and CG Power has 25,000 MVA of power distribution transformers and 6,900 MVA of distribution transformers. Indotech has 9,000 MVA of capacity. All of these players have announced capacity expansion because they have continuous inflows of orders and need to expand capacity. Hill has the largest capacity so far, but players like Voltamp and Shilchar are guiding for multi-fold capacity expansions. In terms of margins, you will see some of these players have much higher margins. So the likes of Voltamp and Shilchar, which command 22 margins, whereas the other players like CG Power still have room for margin expansion. Just to give you a quick breakdown of the transformer industries, there are some low kV transformers with an organized and that is where a lot of these bigger players started to capture the market. Mid-level used by discoms. So discoms are distribution companies, transcoms are transmission companies, and these form a large part of the capex announced in India. Then comes the high power transformers used by gencos, especially the power generating companies or the state. When a new power is set up, you need these power transformers to either step up or step down the electricity, because these electricity is generated high voltage and then it's transmitted to the local grid, from where again a transformer is required. And even when you see these distribution transformers, which are lower kVs, set up outside residential complexes, step down transformers required there. So there are multiple applications of these transformers. We can have a quick look at that, but today I wanted to go through this one particular player in the transformer business, and that is Transformer and Rectifier India. They saw uptick in their business back here 2017, right here. The stock went from a 7.5 level to 5 times, 6 times here in a span of 3 or 4 years. But at this time, the cycle is running for good, and the stock has shown a good run up. If you see from the last 2 years odd, stock has gone to be a 20 bagger almost. But that doesn't mean the stock is overpriced or there is no room to grow, because we'll go to the valuations in a while, a back of the envelope calculation to also show the kind of transformers that these companies produce. And for Transformer and Rectifier India, they have specifically guided for 1 billion revenue in next 3 years. If you look at the revenue, which is 1600 odds, they are guiding for almost doing 4 times revenue in next 3 years. Also, because the export margin is currently almost 2% of their business, and they plan to increase that to 25%, that should lead to higher operating margins. Last time when the cycle turned, they did almost 15% margins. With the recent acquisition they have done into POSCO, Pogan Electrical Steel, which is a major supplier of one of their key raw materials. The CRGO is an important raw material for any transformer companies. They have made this acquisition, which secures that, which is 35% of their revenue. By securing that of their key raw material, they hope this will help them overcome the challenge of fluctuating raw material prices like copper, which causes margins to fluctuate. But that is also one key risk in investing in this company. Coming back to their business, the last few quarters they have started showing better sales numbers, and it is increasing very rapidly, almost 100% increase year on year. If you see this quarter, it was 80%, with a margin expansion quarter on quarter and year on year both. quarter on quarter, the margin has doubled year on year. It has gone 23-fold. Even though optically the P will look very high, but if you look on a forward basis, Y27 is reading this report. This is trading at 20p forward P if you see till FY27. So in India is a market where it's hard to find stocks which are lower P, but with the kind of growth and tailwind the industry sees, and with improvement in margin, it should make this particular stock accurately priced. Again, this is not to mean that you go and buy the stock tomorrow, but this is in no way a stock recommendation. This is one company which is doing or exceptionally well in an industry which is seeing a lot of tailwind. Now, quickly trying to summarize this video. Currently, the revenue, which is, let's look at 2024 revenues, 1290 odd crores. So export revenue for Atra, if I am not mistaken, was 140 odd crores. They continue to see good order book. There's 35,000 odd crores of unexecuted order book. Out of this, 1,000 odd crores have flown in the last quarter. There's 18,500 crores of orders under negotiation. You can see the scale of the order book compared to current revenue, how big this turnaround could be. Of course, this is cyclic in nature, so there will be more players coming in because of this uptick in demand, and that might lead to overcapacity, but next few years look very promising as far as this particular industry is concerned. Coming back to valuations here, I see the export revenue. There is okay, just consider 10% of that in mind. The margin currently, which is 13%. Um, uh, the order book is 3,500 odd crore, but inquiries 18,000. It is that we have from the management is to reach 8,500 odd crores, 1 billion of revenues, and if they do 25% of export, which is what they have guided, this is not an expensive stock in my humble opinion. I might be wrong, but that is my personal view. One risk that I would like to highlight this point, this is a low float stock, so because promoter holds most of the stocks, the actual stock out in the market is very low, and that might result very often in an upper circuit or a lower circuit, so you would struggle to sell the stocks. That's something to keep in mind. Finally, some of the key things to keep in mind as far as this particular stock. This is what I was referring to earlier. They have acquired interest in CRGO steel electrical gate manufacturer. So this helps them get uninterrupted supply of steel, which helps de-risk the overall supply chain. This can help them resource. This is 35% of their raw material cost. So this is a big achievement. This might not help increase their revenue or margins, but de-risk the company overall. 1 million revenue in 3 years, that's the kind of guidance they have gotten. This is one of the interviews the chairman did with NDTV, and the management being so confident. And point that I was referring to earlier, so a lot of these big players outside also have their order books backlog. This is one particular company which, according to the management, their order book is not backlog for next few years, so still there's a scope for more orders, and there's still scope for margin improvement, and with this acquisition they should at least get back to this margin if not more, but the management guides to have higher margins because they are trying to increase the percentage of their exports to the likes of US, etc. That's a good one. It took half an hour. I would request you all, if you like the video, please and subscribe to the channel. I try and put more effort into making such videos, and every week I try and dive into a new sector, a new company, and hopefully you'll get something to learn. Thank you so much for being tuned in, and see you soon.